Hi everyone, Professor Christensen here. Today we are going to take a look at Chapter 1. This is just a quick overview video. It'll be about 20 minutes long, and we're just going to take a look at what is in Chapter 1. And it's not really going to give you the technical stuff, just going to give you an overview, and then the other videos in Chapter 1 will help you with some of the details that you're going to be needing. Okay, so let's take a look first at the learning objectives. So after we study this chapter, you should be able to talk about the two primary functions of accounting. We're going to look at that. We're going to look at what financial accounting measures, determine how financial accounting is communicated through the financial statements, and this here is starred because this is really the most important thing that we look at. That's where you want to spend your time because the financial statements are what this whole course is all about. Okay, we'll talk a little bit about the decision-making process and how we use the financial statements to make decisions. We'll take a look at generally accepted accounting principles, and then finally we'll take a quick look at some accounting careers. Okay, so first off, the primary functions of accounting. What do accountants do? You might think that this is a math class, but it really isn't. Even though it uses numbers, accounting measures business activities and then it communicates it to people outside of the company. So you are going to be using some math, mostly add, subtract, multiply, divide. You'll do a little bit with percentages. There's not heavy math in accounting, all right? So even though it uses numbers, it's mostly about communications and communicating financial information outside of the company. All right, so what are the things that financial accounting measures? So there are three kinds of activities, and please watch the other videos in Chapter 1 because those are going to help really to define this a little bit better. So there are three kinds of activities. There are financing, investing, and operating. And we'll see how those are reported shortly. If you think about, let's think about starting a business, and we'll take a look at Fin. When you look at Fin's business starting, the first thing you have to do when you start a business has to do with financing because you have to get money, right? So financing has to do with how do you get money? Do you borrow it? Do you issue stock? And then investing activities are what do you do with the money once you have it? So are you going to use it to buy a computer, or are you going to use it to buy a delivery truck? Those are investing activities. And then operating activities have to do with actually operating the business. So the revenues, the expenses, are you doing things for your customers and earning revenues? Are you paying salaries? Are you buying advertising? Things like that. Those are operating activities. Okay, so those operating, investing, and financing activities, go back for a minute, are going to be reported on one of our financial statements. All right, so remember those. We're going to come back to them in a couple of minutes. All right, so what are the financial statements? So there are four main financial statements. Again, remember, this is the thing you want to put a star on. Accounting, financial accounting is cumulative. What we learn in this chapter is crucial to future chapters. So if you don't learn Chapter 1 really well, then Chapter 2 is going to be confusing and Chapter 3 is going to be even worse. If you learn it really well, life is going to be good for the rest of the semester. So especially the first three chapters, absolutely crucial. Put as much time as you can into these first three chapters. All right. So here we go. Four main financial statements. We're going to look really quickly now at the income statement, statement of stockholders' equity, the balance sheet, and the statement of cash flows. They are prepared in that order. All right. So let's see what they look like. All right. And then later videos will show you how to prepare them. But let's just see what they look like and what they tell us. So first thing we have here, and this is from our Fin video, is an income statement. Sometimes this is called a statement of operations. So it's showing you the profitability of the company. All right. So let's take a look at what's here. There is a three-part heading. Every financial statement that you prepare will have a three-part heading, and it's going to be very similar to this. You're going to have the name of the company at the top. The second line is going to tell you the financial statement. So in this case, it's the income statement. The third line is going to tell you the date. So for an income statement, it is for a period of time. So this is for the year ended December 31st. So this is for a year. So what happened at Fins during the year? Well, they had revenue of $267,000. They had some expenses, and their total expenses were $213,000. And so they had income of $54,000. If that was a negative number, it would be loss, which is very common in the first year of business. So this company, Fins, had net income of $54,000 this year, meaning it was profitable. Okay, it was a profitable company. And this net income number goes to the next statement, which is the statement of stockholders' equity. So remember I said that the statements are prepared in a particular order, and that's the reason why. You need the net income from the income statement to prepare your next statement, which is the statement of stockholders' equity. Okay? All right, so here is the key thing you want to remember about the income statement. Revenues minus expenses equals net income. All right, so if you know everything that I just said about the income statement right now, that's going to help you a lot. All right, so star that, write it down, put it on an index card, keep testing yourself until you know that revenues minus expenses equals net income. All right, next up is the statement of stockholders' equity. This one looks a little bit messy. There's a lot of numbers here and columns and everything, but let's take a look at it. So first of all, this also has a three-part heading. And notice that the three-part heading is almost identical to the one for the income statement. This one is, though, a statement of stockholders' equity. It is also for the year ended December 31st, 2022. Now, there are three columns, and they're pretty much going to be three columns for our purposes for the rest of the semester, as far as what you need to prepare. When you look at an annual report, say of a company, a big company, there are going to be a lot more columns on here of things that if you continue in accounting, you will learn about some of the other things that will appear in these columns. And we will learn about a few of them later on in the semester, all the way at the very end in our last chapter. So what do we have here? We have three columns: common stock, retained earnings, total stockholders' equity. Now, here's the beautiful thing about total stockholders' equity. It is simply the other two columns added up. All right? So if you have these two down pat, these two columns, there's no need to worry about this. All you have to remember is just to add across, and that's how you get those numbers. Just add across. Okay? All right. So our formulas, the things that are important on the statement of stockholders' equity, there are two different ones because common stock and retained earnings are two different things. Common stock is the money that people have invested into the company, and they bought stock, just like if you decide to buy stock in Apple or IBM or any other company. So in this case, this was Fin, and Fin started business this year, and that's why we see all zeros here. That'll be the only year when you see zeros, okay? Only in the first year of business. So the formula for stock is that you take your beginning balance, you add your issuance of common stock, how much stock did people buy during the year, and that gives us our ending balance. All right, so in this case, Fin put $50,000 into the business, so there's common stock at the end of the year of $50,000. So that's what this is here. Beginning common stock plus the issuance gives us ending common stock. Now, retained earnings is exactly what it sounds like. It's an account that gives a lot of students trouble because it's a little harder to get your head around than, say, buying a piece of equipment. So retained earnings is how much money did the company earn and not pay out in dividends. So retained, it's been retained in the company. It has not been paid out. So what this is equal to is your beginning retained earnings, which here is zero, plus your net income. So that's your earnings, right? Income is like earnings and profits. They're all kind of the same thing. So beginning retained earnings plus the net income. Now, where did that net income come from? Hopefully you thought from our income statement, right? That's where the net income came from. Minus dividends. Dividends are distributions of profits to stockholders. that gives us ending retained earnings. Now, if you buy shares of stock in a company, you might get dividends. They might send you a check, which is the money that they are distributing to their stockholders. All right, so quick reminder, net income comes from the income statement, so you have to do the income statement before you do this statement or be given the amount of net income. And then remember, total stockholders' equity, all you do is add these other two columns up, and then you have your total stockholders' equity, right? These add across, these add down and across. Whoops, sorry. Okay. All right. Next up, so now we have, let's just remind ourselves, we have an income statement, we have a statement of stockholders' equity, and now we're going to take a look at the balance sheet. Okay, so a balance sheet balances. All right, how does it balance? Notice those numbers at the bottom. 204,000, 204,000. That's what we mean by balancing, because your total assets must equal your liabilities plus your stockholders' equity. If you look at your screen and those big letters at the bottom, that's the formula for the balance sheet. Now, the balance sheet tells you what a company owns, its assets, and assets are resources owned by the company that are expected to benefit the future or have future benefit, right? So, for example, if you bought equipment, that's going to benefit you. It's going to help you to earn revenue, right? If you have cash, well, that's got future benefit, right? Because you could use that to buy anything you need to buy. So Finn's assets here are 204,000, and assets come from two places. Either you borrowed money, so you have a liability, and that's what this note payable is, or you got it from your owners, or it's the money that it belongs to the owners. So the common stock, as we said, that's the money that was invested into the company by the owners. That's sometimes called paid in capital, how much people paid into the business. And retained earnings, those are the earnings of the business that have been kept there in the business. That belongs to the owners. So if you're an owner and the company is profitable, those profits accrue to you. Okay? All right, so those are the first three statements. Now, one more. Statement of cash flows. All right, so again, I forgot to tell you something important. The balance sheet is not for a period of time. It's the only one. The balance sheet is as of a date. So think of the income statement and the statement of stockholders' equity and the statement of cash flows as a video. What happened during the year? It's taking place over a period of time. The balance sheet is a still photo. What do we have as of a point in time? So when you see the date on the balance sheet, notice it doesn't say for the year ended, okay? Because that would be incorrect. This is as of December 31st. Okay, so now let's go to our statement of cash flows. We have, again, this is for a period of time. So this is one of the three videos for the year ended December 31st. And remember I said we were going to hear about the types of activities again. Well, here is our operating activities, our investing activities. Finn bought some equipment. And by the way, in accounting, this is a funny thing, but in accounting, we use brackets to indicate a negative number. So you just have to get used to that. We don't use minus signs. I don't know why. I didn't make the rule up, but that's just the way it is. Accounting, if you have a negative number, it's shown with brackets around it. Okay? The other thing you might notice about all of these financial statements is that there are dollar signs typically at the top of every column and then at the very bottom. Every number on the financial statement doesn't have dollar signs in front of it, you see? It would just get messy if you had all those dollar signs. So we usually put them at the top of each column. This is an exception here. And then at the very bottom. The other thing you might notice about all of the financial statements is that at the very bottom, when you get to the last number, it has a double underline. And a double underline is telling the reader, stop reading. That means it's over. This is the end, right? So when you get to net income, you get to total assets, any of those numbers at the bottom of the financial statement, that's where you put the double underline, okay? All right, so Finn had operating, investing, and financing activities like this. And then when you add those three up, you get your increase or decrease in cash for the year. So at the bottom here, you have the formula for your statement of cash flows. Operating plus or minus investing plus or minus financing gives you the increase or decrease in cash for the year. And then when you add that to your beginning cash balance, that gives you your ending cash balance. Now your ending cash balance here is the same number that you had on your balance sheet. So let's go back a second. Here's our ending cash balance on our balance sheet, $134,000. Well, where did that come from? This tells you that answer. This tells you the answer. Well, where did we get cash from? Where did we spend it, right? And so that's how those two financial statements tie together, okay? Now here I have a little note to remind us that the beginning cash balance is 0 because this is the first year of business for this company. Normally, a company's got to have some cash, right? You can't live without cash. And so there will be a number here, usually, if it's not the first year of business. Okay. All right. So what do we do with all these financial statements? Well, decision makers, business decision makers, use the financial statements and other accounting information to make decisions. Now, what kinds of decisions are they making? Well, hopefully you have some ideas in your head. Well, they might be making decisions about who do we buy from? Do we want to buy from this company? Do we want to depend on this company to supply us with the things that we need to run our business? Well, if the company is about to go bankrupt, it's not doing well, we don't want to depend on them to supply the things we need, or our business is we're going to be out of luck when we need this stuff, right? And they're not there anymore. The other question might be, do we want to lend money to this company? So maybe this company wants to buy our merchandise and they want us to give them credit, meaning they're not going to pay for it maybe for 30 days. Are we willing to loan them money? Third very popular decision is, do we want to invest in that company? Do you want to buy stock in Apple? Is Apple a good investment? Best way to find out? Look at the financial statements, because stock prices are more closely related to net income than any other number. Okay, so all of this financial information is used for people to make very important decisions about where they put their money. And you are going to make decisions like that yourself. You might buy a condo. Condos have financial statements. You might want to look at those financial statements before you buy in. I know of condo associations that are run extremely well financially. They have lots of reserves and they save up their money whenever something has to be done. And then I know of others where they never have any money, and every time something has to be done, the people that own the condos have to pay more money. So that's another place that you're going to be using financial information. And by the way, as soon as you go to work, if you're not already working, get a job where you have a 401k, you have to start making decisions about where you're going to put your money, right? So you're going to be investing very soon, hopefully. Okay, so generally accepted accounting principles are second to last thing we're going to talk about today. These are the principles that allow us to compare one company to another. How do we know that Apple used the same rules as IBM to prepare their financial statements? Are they the same, are they using the same rules? Well, they are, because their financial statements are prepared in accordance with what we call GAAP, Generally Accepted Accounting Principles. And those rules are made by the Financial Accounting Standards Board. It's called the FASB, and they're located right here in Connecticut. All right, so finally, careers in accounting. There are as many careers in accounting as, I don't know what, there are zillions. You can do so many different things with an accounting degree, go in so many different directions. There's a huge demand for accountants, not enough people to fill the jobs. It's an excellent, excellent career, because the reality is that every company needs accountants, whether they're doing well, whether they're doing not so well, whether there's a recession, whether business is booming, it doesn't matter. A company still needs its accountants, right? You still have to have your taxes done, even if things are very bad. So accountants are always in demand. So two kinds of accountants are public accountants and private accountants. And I just wanted you to understand the difference because it's something that you might hear about. So if you work in public accounting, you work for a CPA firm, you work for an accounting firm, and you go out to all different clients. So you might go and do an audit of a client, or you might go to a client and prepare their taxes. You might go and help them prepare their financial statements. So public accounting, you don't work for a particular company, you work for the accounting firm. There are 4 very large international accounting firms known as the Big Four, and so you might hear about those. And there are many, many smaller firms. You probably are familiar with an accounting firm in your town, or that maybe someone you know uses an accounting firm. The CPA or Certified Public Accountant is the way to go if you want to be an accountant. That's like the gold standard in accounting. To become a CPA, you have to pass a test, you have to take certain classes, and then you have to get some experience. I'm a CPA. Most of the faculty on the Westchester Community College campus are CPAs, and it opens a lot of doors for you. So if you're going to study accounting, I highly, highly recommend that you go for the CPA. By the way, happy to talk to anybody about any of this. Private accounting means that you work within a company. And there are, again, probably 100 different jobs you can do within a company having an accounting degree. You know, the CFO very likely has an accounting degree. You can work in financial reporting. So, for example, all of the public companies that you can think of, all the big companies, think of any place you go, think of Walmart or Target or any store that you go to, they have to prepare financial statements every year. So they have a lot of people working on their financial statements. So you could be doing financial accounting within a company. You also could be doing managerial accounting within a company, and managerial accounting has to do with making internal decisions. So for example, should we continue to make this product or should we make a different product? Should we buy a new factory or should we use someone else to make what it is that we're making? So those kinds of decisions are management accounting decisions, and those you study in managerial accounting. And there is something called a certified management accountant. So if you're a person who likes management accounting, then maybe the CMA is for you. All right, finally, we have an assignment coming up called the Financial Statement Interview Assignment, which is a fun kind of assignment because it gives you the opportunity to interview somebody who uses financial statements on a regular basis. So this could be a business owner, it could be an accountant, it could be somebody working within a company, but that's going to give you an opportunity to hear from somebody firsthand how it is that they use financial statements. All right, so that is the end of our Chapter 1 overview. Please be sure to watch the rest of the videos for Chapter 1, which are going to help you with detail in preparing the financial statements and understanding all of those elements, the assets, liabilities, equity, revenues, and expenses. Okay, so I look forward to learning together for the rest of the semester. As always, please get in touch with me if you have any questions about anything. All right, take care. Happy studying.